Imagine looking out at the surface of the ocean. It looks totally calm, right? Not a single wave breaking. But underneath, miles below the surface, massive institutional money is quietly, almost secretly, building a heavily fortified bunker. Today, in this explainer, we are decoding the ultimate market mystery, the Black Swan Index. We're going to completely pull back the curtain and uncover exactly what the largest pools of institutional money are doing behind the scenes, far, far away from the daily retail headlines and the standard ticker tapes.
Which brings us to a really tension-building question. Is smart money quietly preparing for a crash? We're going to treat this explainer kind of like a detective story. We are hunting for those critical, hard-to-spot clues hidden deep within options pricing. We want to see what the absolute biggest players in the financial market are really anticipating, even when they aren't saying a single word publicly.
And the main clue we are tracking down today is a very specific, highly elevated number, 149.60. That is the current up-to-date level of the SKEW index, which actually just bumped up 3.56% on the day. To find out exactly what that means, welcome to everything you need to know about finance. Now, just a quick heads up before we get into the heavy mechanics of these numbers. This explainer is just a deep dive analysis into market mechanics and index tracking. It's not financial advice. We're just exploring the data together. And hey, if you find this kind of content interesting, please like and subscribe so we can keep bringing these structured insights straight to you. Section 1. The Black Swan Index. What is the SKEW? Okay, let's dive into this. To really understand the SKU, we have to grasp exactly what kind of catastrophic event this index is actually measuring. It's all about tail risk. This benchmark, which was created by the CBO Global Markets, basically acts as our early warning flag. Now, we've all seen a normal bell curve representing standard day-to-day market returns, right? Well, tail risk represents the extreme, highly unlikely edges of that statistical curve. It is the literal probability of a sudden, severe market crash that lies completely outside normal daily fluctuations. We're talking about massive structural shockwaves here, not just a bad Tuesday afternoon on Wall Street. Let's move to and see how this builds logically in the real world. Here is the actual mechanical flow of how disaster insurance works in the financial sector. Step 1. Institutional investors start to fear a major systemic crash. Step 2, these multi-billion-dollar portfolio managers go out and buy deep, out-of-the-money put options on the S&P 500. They are essentially paying massive, huge premiums for insurance policies against a total collapse. Step 3, because of this sudden, intense surge in demand, the prices of those specific protective puts absolutely spike relative to standard options. And finally, Step 4, that premium discrepancy translates directly into a rising SKEW index. It captures the exact, real-time cost of that fear.
Section 2. Reading the numbers. Deciphering the clues.
Now, what's really interesting about this slide is how it translates index values into actual human emotion. Deciphering the clues requires knowing what a normal market environment looks like versus what constitutes a flashing red light for institutional panic. A baseline level of 100 means the market is perfectly symmetric. The perceived crash risk is basically negligible. Between 115 and 125, we start to see mild concern entering the chat. 125 to 135, that's elevated concern. But those bottom two tiers are where the real story is happening. Once we cross 135, there is significant concern about a severe market decline. And anything 150 or higher, that represents a very high, relatively uncommon demand for downside protection. At that level, the market is practically screaming for an umbrella because it sees a Category 5 hurricane forming. Let's ground this in our actual data for a second. The recent 52-week range for the SKEW index has been hovering between 132.31 and 161.86. Remember our current elevated number of 149.60? Over the past year, this index has lived almost entirely in a highly elevated state of concern. This tells us without a doubt that smart money has consistently been paying top dollar for protection, regardless of what the stock market is actually doing on the surface. And if we pull back and look at the past few years, particularly during the 2020 pandemic crash or those aggressive 2022 rate hikes, we saw similar sustained spikes in this index. It proves that institutional memory is incredibly long. These massive funds are more than willing to pay heavy premiums for safety when they sense any underlying structural instability.
Section 3. SKEW versus VIX. 2 gauges, 1 market.
At this point, you might be wondering, wait, doesn't the famous VIX index already measure market fear? And this brilliantly illustrates the exact difference. Think of it this way. You can think of the VIX as the market's speedometer. It measures day-to-day nervousness, standard friction, and expected daily volatility. But the SKEW?
That is the earthquake detector. The earthquake detector doesn't care about a little daily turbulence or small speed bumps on the road. It is purely scanning the tectonic plates for a massive, sudden outlier event.
Mechanically, here is why that technical difference matters so much. The VIX is calculated using near-the-money options. So the VIX is essentially asking the market a relatively light question: how bumpy is the ride going to be over the next 30 days? The SKEW, however, is heavily influenced by far out-of-the-money puts. It is asking a much darker, much more catastrophic question: what is the absolute statistical chance that we drive straight off of a cliff?
Let's look at two totally different market scenarios to see how this plays out for an investor. In scenario A, the VIX is low at 14, but SKEW is extremely high at 155. This represents a quietly grinding calm market on the surface that is actually hiding massive, very expensive institutional crash hedging behind the scenes. Now look at scenario B. The VIX is a high 35, but SKEW is a low 115. Here, investors expect huge daily swings and relentless choppiness, but they don't actually believe a catastrophic cliff drop is mathematically likely. They expect a wild ride, for sure, but they believe the vehicle will stay on the road. By combining both of these indicators, professional investors can read market psychology and institutional positioning like an open book. High VIX and high SKEW means incredible daily turbulence combined with an extreme, overriding fear of a total systemic wipeout. Low VIX and high SKEW? Well, that's the calm surface, hiding the quiet, aggressive crash hedging we just talked about. And high VIX with low SKEW? Volatile daily price action, but absolutely no major catastrophe expected on the horizon. It's essentially the ultimate cheat code for understanding true market sentiment.
Section 4. Predicting the next crash, the resolution. This leads us right to the climax of our explainer today. Does a skyrocketing SKEW index, like the 149.60 we are seeing right now, actually mean the market is about to collapse? So the crucial point is perfectly captured in this single idea. A high SKEW often reflects investor demand for insurance, not necessarily an imminent crash. The SKEW index isn't a magical crystal ball for exact market timing. It does not tell you exactly when a crash will happen. It simply measures the current real-time cost of insurance against one happening.
You see, SKEW is best viewed as a risk sentiment indicator. It can easily remain elevated for months or even years, while the stock market continues to grind higher and higher to new all-time records. But here is the most fascinating, counterintuitive nuance of all. A highly protected market can paradoxically limit the severity of a real crash. Think about the underlying mechanics. When the institutional market has already paid top dollar to meticulously protect itself, portfolio managers don't actually need to panic sell their underlying stock positions when things get rough. The downside is already fundamentally kept by the expensive insurance policies they bought months ago. Which leaves us with this final provocative thought regarding the future of the stock market. If smart money has already bought all the insurance, how resilient is the future of this market? A high SKEW index might sound absolutely terrifying at first glance, but honestly, it often just means we have a fundamentally well-armored market, fully capable of absorbing a massive macroeconomic shock without completely collapsing into dust. The future of the stock market might actually be a lot more stable than the headlines want you to believe, simply because the big players are already wearing their seatbelts. Thank you so much for joining this deep dive. To keep unraveling the mysteries of the financial world with us, please try out our latest episodes.